It's basically in a rising rate market like we're in right now. That's usually one of the top programs that everyone's looking at right now. Reason is because the ARM loan.
An ARM loan. Hey, I'm John Gomez with Keller Williams here on the Mississippi Gulf Coast. I'm sitting in with David Branch with Cadence Bank. Keep rolling. So David, let's talk about the ARM loan programs. I know there's different year options. What kind of buyer would be interested in these options in this loan type?
Yeah, I mean, it's a great program, unlike the joke you just tried. But the ARM loan is basically in a rising rate market like we're in right now. That's usually one of the top programs that everyone's looking at right now. Reason is because the ARM loan stands for adjustable rate mortgage. There's a fixed period of time where you're going to be able to have a lower rate,
okay,
and then it will adjust in a certain amount of terms. So, for example, let's take a 5, a 7, or a 10-year ARM.
Okay.
The payment's going to be based off a 30-year mortgage,
okay,
or whatever term you want. But the rate is going to be fixed at that beginning, say the 5, the 7, or the 10 years for that specific time. So on a 10-year ARM, for the first 10 years, that lower rate is going to be fixed at that 10-year period.
And the pause you there. So
yeah.
Like with an ARM, 10 years, we're going to see a better rate on that program versus your other 4 traditional loan types.
That's correct.
Okay.
So your 30-year fixed is going to have a higher rate in the market that we're in right now compared to a 10-year ARM, where that 10-year, you're going to have a lower rate during those first 10 years.
Okay.
And then it'll adjust after those 10 years or whatever it is. And then once per year, it can adjust to whatever the current market is. Now, there are some ceilings and some floors of what the rate can adjust to based on like a margin of whatever the market is at that time. So different ARM programs that are out there have some different criteria,
Okay.
but it's not going to just, jump to 50% or anything like that. That's not how the ARM.
So there's a ceiling to that jump. Say after you choose the 10-year program, there's a jump.
Yeah.
That's expected, but there's a ceiling cap to it.
There is, but it could also stay the same. I personally have an ARM loan on a property that I own, and it's gone down for many years.
Good.
It has gone up right now, but my payment still has been less over what it was originally.
Sure. Okay. So to me, it kind of sounds like an ARM loan could be really smart for, say, someone who's X amount of years out from retirement and knows that once they retire, they're going to collect a big pension or payday out of stock funds or whatever it may be.
Yeah.
So they can lock in lower than the current market rates with the plan of whether it's 5, 7, or 10
Yep.
years, and then cash out and pay their property off. And
Yeah.
if it makes sense to pay it off.
That's right. And every scenario is different, but that's a great point of someone that might want to use it that way, or it might just be somebody that wants to take advantage, have a lower rate with the notion or idea that rates are going to come back down. They know they're going to refinance when rates come back down.
Gotcha. So if we feel like we're kind of flirting with I hate to say the word ceiling, but we're flirting with high rates right now, we can lock ourselves in a little bit lower than the current market with the expectation, kind of like playing the stock market.
That's right.
We're expecting rates to come down and we'll cash out a little better later.
Absolutely.
Awesome. Well, you got more questions about that? He's your expert, David Branch with Cadence Bank. John Gomez, Keller Williams. We would love to help you. Y'all have a great day.